Hey guys, Steve Welch here. So this has come up several times, so I wanted to kind of bring it up and kind of approach it with you just so that you guys can kind of understand this. So kind of the idea is that you're looking for a vehicle, you're trying to stay at a pretty low payment. So you call somebody that's a car guy like me, and you're going, hey, I want a $10,000 car. Why? Because you want to have a $200 payment. And you've been on payment calculators and you've been on all these things, and you're going, all right, well, I found an interest rate that's this, and I found and I'll do 72 months and then whatever, and I'm going to come and I'm going to buy that 2012 4Runner, and I'm going to pay 10 grand for it, and it's got 190,000 miles on it. It's that I'll finance it for 72 months, $200 payment, and there I go. And then you get to either a dealership or you go to your bank, and they're going, well, no, that doesn't work that way. And you're, no, I want to finance it for 72 months, and I want a $200 payment. And a lot of times people don't realize that that's normally not going to happen, and there's a reason. All right, and I'm going to try to slow this down in a very easy way so that people can understand it. So the way that I tend to put it to people, just to kind of soften it a little bit, is that to a bank, you have to realize that you're a set of numbers. And I know it sounds a little demeaning to say that, but it just follow me here, right? What you are is a set of numbers. Your credit score, your payment history, how many payments you've made on time, stuff like that. Whether or not you financed anything large, like a house or a car, something along those lines. You're also your income, that's part of it, right? But you're a set of numbers. And then you've got you as the set of numbers, and then you've got the vehicle is now a set of numbers. So if you're looking at a car that's 10 or 15 years old or something like that, you have to realize that a bank starts to incur greater risk with an older vehicle or a higher miles vehicle. So the bank starts to do one of two or two of two things. They either shorten the term that they'll let you get on the loan. They'll say, look, I understand you want a $200 payment over 72 months, but what we're going to allow you to do is a $500 payment over 28 months. Or they'll do something, crazy like that, right? And just kind of understand, I'm not doing I'm just trying to give you a rough idea, right? So they're going to do something along those lines. You're going, wait, I want 72 months so I get the payment I want. And the bank's like, yeah, we're not going to finance it that long. Or, you might even have, say, a 2020 model car, so a newer car, and it's got 250,000 miles. Well, it does the same thing. It's still a set of numbers. But the bank looks at it and says, all right, well, you got 250,000 miles on this car you're buying, and you're going, yep, it's a $10,000 car, I want 72 months, and I want to have a $200 payment. And the bank's going, all right, well, we can give you the 72 months, but your interest rate's going to be 20%. And you're going, what? The risk is higher, right? And they might not even do the 72 months. They might come back and go, well, we're going to do 24 months at a 20% interest rate. And you're going, well, I have an 800 credit score. Why are you giving me a 20% rate? And it doesn't wrap into people's heads a lot of time that the interest rate is it's almost like an insurance, right? Insurance policy. The interest rate is based off of the amount of risk that the bank is taking. So think about the least amount of risk. A brand new car on somebody with an 800 credit score, financing it 60 months, right? What's the risk? The risk is very minimal on there, and you're going, okay, so I can get a low interest rate. Well, obviously sometimes captive lenders even give you the zeros, the ones, the twos kind of things. But that's the one that might be like Toyota Financial or Nissan Financial or whatever the captive lender is to the brand. But realistically speaking, a regular bank just giving you a number that you're going, okay, I believe that number's a fair number. For that to come through, you need to put them in the best position possible. So a lot of people out there, I want $200 payment, 72 months. You're just not going to get that vehicle like that. So what a lot of times I've been able to show people is, well, instead of that $10,000 car, you go to a $20,000 car and you have a lower payment. And people are like, how do I have a lower payment on a $20,000 car than I would have on a $10,000 car? And it goes back to what I just said. The risk is lower. And you might ask, why is the risk higher on a 250,000 mile car? All right, so you buy a 250,000 mile car and it breaks down at 280. And you go, nah, I'm not paying the loan no more. Let the bank come and get it. I'm not paying that. Car's broke. And people do that, right? And you get your credit trashed, everything else. They get a repo on there, and then they sell the car for $200 at auction, and then they've got to chase you for the difference. And chances are you're probably not paying anyway. If they get a judgment on you, do you even have a job? I mean, the bank's looking at it like that, right? So if you put the bank at a higher risk, they're not going to like you. Now let's turn something else around. Let's say that you have that, $20,000 car that you're buying. So let's go to a $20,000 car. You're on 72 months on a $20,000 car, because now the bank will hit there. Why? Because you're probably 5 years old, something like that. Maybe 6 years old. Maybe you've got around that 100,000 miles. Maybe it's 110 on 120 on a Toyota. Bank realizes the longevity of a car, and they're going to look at what the risk is, and they might go 72 months. They might say, hey, we'll do 60 months on it because you're at 120,000 miles, right? So they're going to be doing things like that. So when you're looking at a vehicle, don't just go in, and that's the whole point of this video. Don't just go in there and go to a payment calculator, do whatever interest rate it's got pre-populated in there, which I've seen several of them that are like 5.99 that they've got like pre-populated into these little payment calculators. And that's, might be a special rate on something, but a lot of people get higher than that. It just depends on what you're buying, right? And once again, what the risk is. But you take that pre-populated interest rate, you take the pre-populated amount of term, or you make it 84 months. Let's do 84 months on this $20,000 car. They're not giving you 84 months, and they're definitely not giving it to you at $599. And they're those kind of things, you can start having those conversations. But the problem that you run into is there are a lot of people that use the payment calculators, and they end up not being realistic numbers. And then they go, well, car dealership didn't get me the number I wanted. It had nothing to do with the car dealership. We'll do whatever the bank, will accept, of course. But you're going to have a problem getting that cheaper car financed, especially at a longer term, especially at a lower rate. Because you've given the bank all the risk, and you might go, I've paid all my bills on time. I've never been late. And 100%. I hope that's the case, because you probably got pretty good credit. But that one hiccup, that $5,000 repair on a $3,000 car, that hiccup, where you're going, well, I might as well just give the car back, because I'm not going to pay $5,000 for a car that's it's worth $3,000. If it's fixed, it's worth $3,000. Why am I going to put $5,000 into it? And you might go, well, I only owe $2,500, so the numbers might actually work on paper. But if I owe $2,500, I'm not paying that $2,500. I mean, I got a broken car. Why would I do that? And people get into this mindset and just go, let the bank take it. So now the bank's got the expense of taking it and everything else like that. And that's why you're going to pay a higher payment on a cheaper car. And it's not that much harder than that. But the other thing I'll point out too is that, and a lot of people don't think about it this way, the difference between a $10,000 car and a $15,000 car, it's a lot. The difference between a $15,000 car and a $20,000 car, it's a lot. The difference between a $20,000 and a $20,000, you kind of get my point. So as you go up, what you get for a few more thousand does change pretty dramatically. I mean, like you could see kind of what we were talking about with the difference between a 10 and a 20 earlier, and that would be pretty accurate. You can go longer term, stuff like that. Why? Because you got a car that's got lower miles, more time left, and it's there's something called retail life, and that's something that an easy way to kind of figure out whether or not it makes sense, right? So the retail life on a car is usually somewhere, and retail life doesn't mean that that's how long the car lasts. Retail life means the amount of time that it legitimately could go on a branded dealership's lot, meaning that if the bank has to take it back, when can we still get the most money for it, right? So how long is a reasonable amount of time that can go on a branded dealership's lot? Realistically, there's a couple numbers that come into play, and it's 10 years and it's 100,000. And most people are like, well, most cars will go 200,000. Sure. Most cars are, could be 15, 20 years old. Sure. That's fine. We're not going to argue that point just because I can agree with you on it. But the point is that if you have a 10-year-old, 100,000 mile car and you're trying to finance that car, what's the term? What's the rate? Can you get it approved or not? What kind of credit score do you need to get it approved? Start thinking in the mind of a bank, and you'll know what you can buy. And you'll know why that, the vast majority of times on a branded dealership lot, you see something that's 3, 4, 5 years old, and then you'll see something that's got 40 to 75,000 miles on it. Why? Because you fall in the sweet spot. You get a little bit better rate, you still go to a longer term, you can keep a lower payment that way. Those are the ones that you seek out when you're looking for cars, because that's kind of the sweet spot. So, like I said, just a conversation. We always have conversations on here, but I've seen it a lot of times where people, they think that they can get those things. I want to add one other thing too. So, the other problem that you run into is the car that you're trading in. There's a lot of people who go, all right, well, I'm going to get this 2012 Camry or whatever, and I'm going to trade in this 2009 Nissan that I owe $5,000 on. And basically it gets appraised and they say it's a $500 car. All right, well, that 2012, now I want to finance. I want to finance in my negative equity because I heard you could do that, and I'm going to roll it into the new car. So basically realize that 2012 is probably priced somewhere near book value. Maybe a little above, maybe a little below, just kind of depending on the car. But like I said, the banks are looking at numbers. Well, the numbers they're going to look at, they might look at a JD Power, they might look at an NADA, a Black Book, KBB. They're going to look at something like that. MMR is one that they look at a lot, which is the auction report. So they're going to look at things like that, try to figure out exactly what the value of the car is. And you're going, all right, so the dealership or whoever you're, buying the car from went ahead and priced their car at $10,000. Is that 2012 Toyota Camry? They priced it at $10,000. And you're going, all right, bank, now I've got my old car I'm trading in, and I need you to finance the taxes on that car, taxes and any fees, plus another $4,500. And the bank's going, that's double the value of the car. The risk level isn't worth it. We're going to go ahead and turn you down. And that's what they say. So by the time you send it through, or they might not turn you down. You might have good enough credit. They go, you know what? We'll go ahead and approve that car with $4,500 down. And you're going, well, that's how much I'm negative. Yeah. Because you could have got approved with no trade. But now that you're trying to get out of that old hoopty that you've been driving, that's where you're at. So, like I said, I'm not trying to give anybody advice. I'm just trying to tell you, scenarios and why a lot of times you'll end up seeing that a little bit newer of a car with a higher cost might have a lower payment. Now, here's the other thing. So let's say that you're buying a brand new car. So here's how the negative roll works, right? If you're buying a brand new car and it's $50,000 and it's got a $2,000 rebate, and so now you're $2,000 less, and then you pay your taxes on there. You add that $4,500. You're still at, after you add all your taxes and fees and stuff like that, you're at 120% loan to value. Bank will take that loan with good credit, in most cases, right? I mean, as long as they want to, but they'll take that loan in a lot of cases. 120% loan to value, they'll do that. But people forget to add their taxes and fees. So they go on those little calculators like we were talking about, and they go, all right, well, I'm on a $10,000 car, and I'm going down there, and it's 5.99%. That's what it's got pre-populated. That must be the answer. And then you come down, you're going, all right, well, and then taxes and fee. Well, no, don't include that because I don't want to pay that. And then you don't check that little box that's on the bottom, because I've seen those too. Do you want to include taxes and fees? I'm not checking that. It makes payment go up. So you just kind of realize where you're going. Obviously, if there's the old thing, you can get 0% interest if you pay cash 100% of the time, right? But it's not everybody can do that, right? Not everybody can pay cash for a vehicle, right? I think it's like 92% of people finance their cars. So no, not everybody can pay cash for a vehicle. So vast majority of people will finance at least some of it. You might put $10,000 down on a $50,000 car and finance the rest. I mean, there's people that do that. Put you in a better position where the bank's going to offer you the very best rates, most likely in that case. Why? Because you put the bank in a good position. The other thing, I don't keep adding stuff. The other thing that I'm going to say too is that remember, if you ever want to guarantee an approval, right? And a lot of people are like, well, you probably can't guarantee an approval. You can come darn close. If you want to all but guarantee an approval, make it to where the bank's happy if you pay and happy if you don't. And you might go, what do you mean? So here's what it is. So say the bank's offering you a 10% loan, all right? And over 72 months, and you've got an 800 credit score, or maybe even you had a 650 credit score. Let's just say that, because that's where it might pop up. 800 credit score, you might get approved. Anyway, so you have a 650 credit score, never had a problem. Maybe there's a couple of student loans you're late on, or some medical debt or something that kind of brought you down, but nothing that's like egregious, no like car repos or stuff like that, right? So you have the 650 score, and you're going, all right, well, I want to buy a car, and I want this, let's say it's a $30,000 car, right? I know I'm jumping numbers around here, but say it's a $30,000 car. I want to buy this $30,000 car. I have a 650 credit score. I'm going to put $15,000 down on a $30,000 car. So the $30,000 car, by the time you do tax and fees, depending on your state, stuff like that, let's just say it's 35. So you put $15,000 down, realistically, for the next 2, 3, maybe 4 years, and you keep making your payments. But the bank, if you didn't make your first payment, and the bank was to go and repo the car and sell the car, they're happy. They're ahead. They've made money on that car by turning around and selling it, right? Now, let's say you make all your payments on time, you get all the way to the very last payment, and you paid off that last payment, but you did it at 10 or 15% loan rate, and you were up there on the loan rate, right? Well, bank's happy. They got all the interest. You paid all your payments on time. They're very, very happy with you, right? So the bank's happy if you pay, and they're happy if you don't. It's when you get into that little gray area in the middle where they're going, I don't know about this one. That's where you start to get approval issues, right? So I'm not a finance manager, never claimed to be a finance manager. I've just been around for a long time when it comes to that. And it's just stuff that I see and stuff that I hear about. And I've seen, I've sat with people before where I was trying to explain to them, look, you've got a 650 credit score, you're financing in $4,000 in negative equity, and you're trying to tell the bank that you want to do it with $200 down. The bank realizes that you're living on a pretty tight margin. So you've made it to where the bank is taking all of the risk. And maybe they said no. Maybe they said, yeah, we'll do it with $5,000 down. Maybe they said they're going to do it, but it's a 25% interest rate. Who knows exactly what they'll say they're going to do, but sometimes you get, maybe you need to take it for now and refinance in a year. Once you've reestablished yourself that you're going to pay your loan, there could be some things like that. But just realize when the bank's looking at it, they're not looking at you and going, I don't want to finance this person because I don't like the way they look, or because I don't like this or that, or whatever the thing you think. They're not saying no because of that. They're just, all they see is numbers. Numbers on the car, numbers on the credit score, numbers on income, numbers on, payment, debt to income, the things like that. That's what they see, and that's literally what they make their decisions off of. And it's not the dealership. So remember that too. So a lot of people are like, oh, the dealership declined me, or the dealership did this, or the dealership. When it comes to the financing, the dealership wants to help you all the time. They all the time want to help you. The only problem is when, like I said, when you've got those little hiccups, and a lot of times the dealership will help you work those out. Maybe they talk to the bank. Maybe they get the bank to do a concession for you. Maybe it was an auto turned down, but they're fighting for you and trying to get the deal approved. Hey, you never know, right? That's the whole point of why I made the video. But just being realistic. Remember, sometimes a higher dollar car can have a lower payment. Sometimes it's, you're going to have higher interest rates on cheaper cars. Oh, I'm only financing 10 grand. Why is my rate so high? That's why. The car is the big risk at that point. So there you go. But you guys have a good one. We'll talk to you guys later. Bye.